Alrighty, everybody. A short lesson today. It is a continuation of the conversation that we had yesterday. So if you did not watch the video on exchange rates yesterday, please do so. Remember, exchange rates are entirely based on supply and demand for the currency. If people want a currency, that's going to increase the demand and cause the value of that currency to rise. If people want to get rid of their currency because of some factor, that means that their supply for the currency is going to rise as they provide more options to the, or as they provide it to the foreign exchange market. Okay. So if we want it, demand rises. If we want to get rid of it, or if we're buying another currency, supply rises. So remember, we talked a couple weeks ago about monetary policy. Monetary policy can be broken down into these three things: open market operations, the discount rate, and the reserve requirement. Okay, that's how the Federal Reserve controls the amount of money in circulation. Okay, now the amount of money in circulation is inversely related to interest rates. And so what that means is that the more money there is in the economy, the lower the interest rates will be, and vice versa. The less money there is in the economy, the higher interest rates will be. And so what today's lesson is all about is what happens if we use expansionary policy and what happens if we use contractionary policy. If we use expansionary policy, that means we do something like buying bonds or lowering the discount rate or lowering the reserve requirement. That will cause the money supply to rise, as it says right here. That'll cause money supply to rise. And because we know that money supply is inversely related to interest rates, money supply rising causes interest rates to fall. And when interest rates fall, that means that investment rates go down. Because if you are looking to save your money, if you're looking to invest your money, you want to invest it in something that has a high rate of return. And if the interest rate is going down, that means that you do not want to invest in that project or in that investment, whether it be a bond or a stock or something like that, right? And so people are going to want to get rid of the dollar. If I give you a choice between a 5% interest rate on a savings account and a 12% interest rate on a savings account, you would choose 12 because that gets you more money year by year, more money in the long run. And so if interest rates are falling, that means that people are going to want to get rid of the currency. They're going to want to get rid of the dollar because they can get better rates elsewhere. And so the supply of the US dollar will rise in the Forex market, the foreign exchange market from yesterday. We want to get rid of it. That means that the supply will rise and the value of our currency is going to fall. We call that depreciation. And yesterday's lesson, when we depreciate, exports will rise and imports will fall. More people want to buy our goods because it's cheaper for them to buy our stuff, but it gets more expensive for us to buy other countries' stuff, so our imports are going to fall. So when the Federal Reserve engages in expansionary policy, that causes the money supply to rise, which eventually leads to a rise in exports and a fall in imports. The exact opposite happens if the money supply falls. If we use contractionary monetary policy, that means we're removing money from the economy. That means we are shrinking the money supply, so interest rates are going to rise because, again, inversely related. Those interest rates rise, and when interest rates rise, people are more likely to invest. You get a better return on that investment. And so you want the dollar. So the demand for that currency, or the dollar in this case, is going to rise. And when the demand for a currency rises, that leads to appreciation because the value of that currency is rising as it is in higher demand. And when that happens, when we have appreciation, that means fewer people buy stuff from us because our currency is more expensive, but we are going to buy more from other countries because our currency goes further overseas. So as you're doing your assignment, I'm going to post this document as well. You can have this out as you're working through the assignment, and then on the assessments later this week, you can have this flow chart out to kind of look, step by step what happens with the money supply. Okay? Let me know if you have any questions, and I will talk to you guys tomorrow.